Hello and welcome to the show. It is great to have you with us. Let's start things off by taking a look at the charts of all the major stock indices. As you heard, we're near all-time highs. You can see the U.S. stock markets are sitting at or near record high levels. Look at that chart. It is a thing of beauty. Now, not to be outdone, let's take a look at the TSX. It is traded up every single day in November and is also at record territory. So what's been causing the recent market euphoria? And the bigger question is, can this bullishness last? Joining me in studio, Brad Simpson, Chief Wealth Strategist at TD Wealth. It is nice to see you.
Nice to see you, Kim.
Nice to see you with all that green's on the screen,
nice,
too.
Yes, indeed.
Brings a smile to our faces. The last time you were here, things were a little bit different. We were talking about inverted yield curves and recessions and trade wars, and we've forgotten all about that. Take a look at the markets now.
It's remarkable what, in a brief period of time, how the tone can completely change another way.
Yeah.
Welcome to the power of central banks still.
Yeah. Yeah. Again, and I guess, that's the one thing that I think, even a year ago we were talking about, rate increases, and lo and behold, rate cuts.
Yeah, I think if we learned anything over, say, the last 18 months is that I think the whole goal of the last decade was to have central banks involved in the economy and to back away. And I think what we saw in the fall of 2018, wait a minute, let's slow down with the back away. And in very short order here, we went from a world that was worrying about 3 interest rates increases to all of a sudden a world where we're starting to see interest rate decreases, and with the sole intent of to get growth going again.
How long can it last? I mean, the fact that we actually thought things were going to change around and we've all become a bit addicted to what the central bank has to offer, it continued, but it can't keep continuing. I mean, can it?
Well, maybe it can, right? I mean, or at least it can for a good deal of time. Like if we looked at what the market is telling us right now, let's look at the European Central Bank. Really, the market is now priced in that over the next 6 years that the European Central Bank is going to add about $1.2 trillion to its balance sheet. Mm-hmm. I mean, that's being fully involved again. If we look at the Federal Reserve Board, if I was here a year ago, we would be talking about the program of starting to reduce their balance sheet. And in the course of a quarter and a half, all the moves that they made to reduce the balance sheet, all of that is back on again. If you look at it in those terms, and if you kind of look what the market is kind of saying, well, that this really long, slow recovery that we've gone through, it could go on for a lot longer than what you think.
Let's talk about the long, slow recovery. I mean, when you take a look at growth in that, What does that mean in terms of economic growth? What are you seeing? And I want to get that into what it means for investment returns. But
sure.
But I know you've got a chart here, and I want to take a look at this.
Sure.
This is a Caterpillar.
Yeah.
Good bellwether versus yields.
Yeah, I think what it tells us is that if we went back 3 months ago, we kind of lived in this world where you had technology stocks and you had utility companies, and those were the 2 really expensive areas of the market. And because on one, you were prepared to anything for growth, on the other was anything for safety. Now, when you look at Caterpillar here, what it's showing us is that as interest rates are working their way up a little bit, it's the belief that as we go out 6 months to a year out, that we're going to have a stronger economy, and a company like Caterpillar is really going to benefit from it. So when you had the interest rates going down, you would see a company like Caterpillar saying, well, gee, the economy is going to slow, and it's going to slow a lot more than what you think. The moves here the correlation between the 2 is really saying, oh, what might be the central banks have made it really clear they're going to do what it takes to get this economy to go and keep going.
What does that mean for investment returns?
Well, I think a little bit of, we're going to have to change our expectations. I mean, as we were going through charts at the beginning here of all-time highs. Yep. We published a paper a couple of weeks ago in working with TD Economics, where we said, we need to change our expectations a little bit of what returns could be going forward. So, if we were looking at a balanced portfolio that would be doing somewhere between 6 and 7%, we would now look at that and go, well, we might change our expectations to around 4 to 5%, and that's a still good return. But it is different, and a lot of that is because of just how low interest rates are. that other 40%, which is the yield part of the portfolio, isn't returning what it used to.
Let me bring up a chart here. This is, I know, your favorite chart. You bring it when you come, but it's taking a look at risk allocation when you're taking a look at diversification across your portfolio. The one thing I know we talked about from day one, you've hammered into my head, and I will not forget it now, is that you want to make sure that where you're even though you may be broadly diversified against public trading equities and bonds, those things, you actually may have a very concentrated risk allocation. You got to watch that.
Right. So, I mean, to me, this chart is what we're saying is we could open up and look at a balanced portfolio in terms of risk, kind of a dark green dots. That really showing is that almost 90% of this portfolio's risk is equity risk, what we call equity factor, and then the other kind of 10 is kind of fixed income risk. To the right, the kind of the beautiful color chart, if you will, is this idea that if you could broaden your risks that you're taking, if you could say, look, there's fixed income risk and there's equity risk. There's something called alpha, which is the risk that you can take outside of the normalized returns you're expecting to see, and currency risk. And the last one, illiquidity. Illiquidity, there tends to be a premium for putting your money into something that you put it into, but you don't expect at any time that you can take your money back out.
Right.
And if you can build a portfolio that better manages these risks versus just always trying to go, what's going to happen to equity markets, can make a really big difference, not only to the diversification in terms of your portfolio, but it can make a real difference in your returns as well.
Let's talk about that, because I think that's the one thing people need to understand too from your standpoint is you're not just looking at public investments when you're dealing with your clients. You're looking at the whole spectrum in terms of public and private absolute return strategies and all that stuff. You've brought in a chart here which I think is interesting, which shows annualized returns on all these different classification of assets. And paired at the bottom, though, is something called a pain index. I'm going to ask the control room, leave this up for a second, because I want to explain what we're seeing in the top row here.
Sure. So the top row is what we did is we said we want to go back in time, back to 1992. And the reason we're going back to 1992 is we wanted to find one cycle where interest rates were going up. And kind of mid-1990s, we saw interest rates bump up a little bit, which has an impact on returns. So really simply what we said is where's the best rate of return? Well, over the period of time from 1992 to 2019, best rate of return was in the S&P 500.
Yep.
Now, as we go down a little bit, we said the second best was absolute return strategies. So those are things that can go long and short in the market. And then we said a little bit down over there is real assets, so infrastructure, power, real estate. Now, so I know all of us would be pretty happy if we were in real assets and we made just over 8%, or we made 10% in the S&P. Now, the next one down is showing something that we use called the pain index. Now, pain index is kind of interesting, right? And it is kind of what you think.
Sounds not interesting, but it is,
right? And so the pain index, what we do is we measure very simply, said if you had an investment over a long period of time, you would look at when it fell below its original cost base, how often it did that, and for what amount of time was it below its original cost base.
Yeah, so my anxiety whenever it falls below what I bought it for.
Yeah, so the higher the number, so the more pain you experienced, the lower the number, the better it was. And what kind of is interesting is that while the S&P 500 had the best return over that time, you also experienced the maximum amount of pain.
17%.
Yeah, you really had to be there, right? But by adding strategies like real assets to the portfolio, using absolute return strategies, our alpha strategies to it, it dramatically reduces the pain that you experienced, and the difference in return is about 100 basis points.
Right.
And I think a lot of us would say, well, gee, that's a pretty good trade-off. And so for us, really, those are really the kind of key tenets for us. One is to be able to think, we always say in our investment philosophy, we want to mitigate the inside risks, and we want to manage to this pain index.
Always a pleasure, Brad. Thank you.
Thank you.